Hello, everyone. My name is Mike Frick. I'm the Chief Deputy Treasurer Portfolio Manager for the Treasurer of State's Office. Treasurer Mitchell, just to let you know a little bit about my background here, I've been almost 20 years in the portfolio management position. Treasurer Mitchell is my 7th state treasurer, and it's been a real pleasure serving that many treasurers here. And I'm still very honored to be working with Kelly. And anyway, pretty much what I'm going to be going over today, your permissible investments. At the state level, I pretty much can invest exactly what you can, with the exception of a little bit of maturity differences, and we can buy commercial paper directly, which you can't. Pretty much everything else is very similar. Maybe the size would be different. I have currently about a $9.2 billion portfolio that I'm managing in-house with an assistant. So that provides us the ability to, not only invest for liquidity purposes, but also try to extend out, if it makes sense, to get some yield. But anyway, because of that, I'm pretty comfortable with all the investment options that you would be able to invest in. So at any point during the year, if you have any questions, please don't hesitate to give me a call or send me an email. I'd be glad to try to talk through some options that you might be looking at, or if you just want to kick some ideas around, I'd be more than happy to do that. So anyway, I would next year, hopefully we can all do this in person. It's a lot more enjoyable when we get a little interaction between our audience. So instead of just going through these slides, but so bear with me. I'll try not to make it too boring, but it is what it is. We're going to go through the statutory requirements and what you can invest in. And I believe you'll have the time to ask questions after this at some point. So that's when you can ask some questions during the virtual sessions of this. So anyway, I'm ready to begin. All right. As I had mentioned, we're going to be talking about the permissible investments. Really, your statute cover all your legal aspects of your public investing. Now, the goals for investment in your public funds, basically, we all abide by the same rules: safety, liquidity, and yield. First and foremost, we want to invest in safe investments. We want to protect the public funds. In many cases, it needs to be liquid in order just to meet cash flows. So we always keep that in mind during our investment process. And then yield, as is, I should say secondary, but we try to get the best yield we can with the safety, liquidity points in mind in everything we do. But the next thing, then, to try to get yield, you might be able to. My second bar here talks about diversification of investments. That is where you might be able to get some different yield, depending on how you meet your liquidity, cash deposits, and that sort of thing. And then you can look at your other permissible investments to try to diversify and possibly pick up some yield. And again, all your legal investments are under IC 5-13. So if the main statutes, which I'm sure many of you looked at this, you got Chapter 4, which talks about all the definitions of our public funds and investments related to that. Chapter 7 talks about the local boards of finance, whether you're a county or a town or whatever. That Chapter 7 describes that. Chapter 8 talks about the designation of depositories, which is very important. Chapter 9 is the biggest chapter as far as your permissible investments, deposit investment powers. And then Chapter 11 is a statutory area that talks about investment cash management system, if you choose not to do it yourself. PDIF insured accounts, and this slide we are talking about, and I'm sure you're very aware of this, but Public Deposit Insurance Fund protects public funds. Those are protected and insured as long as your deposits are with an approved depository. And public funds, essentially, and the references are code cite, but really public funds are any dollars coming into the hand of a public official by virtue of that office. That makes it a public fund. So most of you, I'm all of you that are here today are public officers, so you're dealing with public funds. The main thing, again, to make sure you have PDIF coverages, you've got to have your deposit with an approved depository. And that is all financial institutions, if they want public funds, go through the process of becoming an approved depository for public investments as well as state investments in Indiana. The PDIF covers losses over and above the $250,000 FDIC limit. So keep that in mind. There is a statute that could also help you maximize your FDIC insurance coverage. Now, again, because we have the PDIF, Public Deposit Insurance Fund, over and above $250,000, if it's with an approved depository, it doesn't necessarily have to be. You're not as concerned about FDIC insurance coverage, but if you really want to keep that in mind, there are some options here. Two products are CDARS and insured cash sweep accounts. Those are products that you deposit with an approved depository in Indiana that offers, not all financial institutions offer these products, but if they do, you could deposit your money with that financial institution, and they have reciprocating agreements with other financial institutions participating in these programs that all the money, whether it's CDs at $250,000 maximum limits or basically a cash account deposit up to $250,000. Say, so if you deposit $1 million in one of these institutions, they're going to parcel it up in 4 different, approximately $250,000 parcels of whether it's the CDARS related to CDs or the insured cash sweep. They have a reciprocating agreement with other financial institutions. So as this initial financial institution you deposit with puts that out to another financial institution, they then return $250,000 back to that bank that you deposit at. And really what we're doing there is kind of ensuring that our community banks, Indiana banks, are not losing our public funds deposits. So your $1 million may go out with other reciprocating banks around the country, but that bank is still getting $1 million from other reciprocating banks. That's important. We want to keep Indiana dollars in Indiana institutions. And that's by doing that, you can maximize your FDIC insurance coverage because, again, they don't exceed the $250,000 limit per deposit. Under this statute, 5-13-4-7, it talks about your authorized bank products, which are deposit accounts by statute. It lists those deposit accounts. I don't know what year this was added. I'm sure it's been a while ago, and I don't even know. It talks about now accounts, passbook savings accounts. They have different names all over, I'm sure, today. But the bottom bullet point there talks about any interest-bearing account that is authorized and offered by a financial institution in the course of its prospective business. That's basically covers all deposit accounts. The other thing to keep in mind is a deposit account, by this definition, does include certificate of deposit. So during the course of other statutory code sites, they may reference a deposit account or a transaction account. The transaction account, I believe, is on the next slide here. Yes, it is deposit accounts other than certificate of deposit. So if you're looking at a statute that talks about a transaction account or deposit account, just keep in mind deposit account includes all bank deposits and CDs. Transaction accounts are all bank deposits other than CDs. And there are special rules for political subdivisions of keeping those deposits or establishing transaction accounts and depositories within your political boundaries. That is set up by 5-13-8-9A through E. This does not apply to county hospitals. They have their specific statutory guidelines. A little different. They don't necessarily have to stay in a political boundary. And then the certificate of deposit required procedures talks about getting, again, a lot of these, if you have in your political boundaries, if you have financial institutions within that or your Board of Finance approved depositories within your political subdivision, you get your 3 quotes if there are 3 financial institutions within that. And as I was reviewing my slides again, I looked at this. It's kind of funny. It's never hit me before, but it talks about bullet point number 1, the quote may be taken by phone. This was added in 1987. So obviously this was prior to the internet. And I'm sure what the thought was at that time, it's easy. Instead of going to each financial institution, walking in and say, I need a quote for my CD. They say, hey, you can do this by phone. And if you do it by phone, you take your quote, get your memorandum, and you retain it as a public record. It probably needs to be updated, obviously. And I think internet emails would be much better. You don't even have, now you've already got a record of your solicitation of a quote. You got your response. I do that all the time. Every financial institution I work with, when I'm putting quotes out, then I'm printing off that email, and that's my documentation of my quotes. So anyway, as I was looking at that, I've never thought about this before, but it's kind of funny that it's taken by phone. So anyway, I would think, and I may be speaking on behalf of the Board of Accounts, but I can't imagine this being an issue. It should be, emails would be the way to go. So anyway, you get your quote, and then you place your CDs with the highest rate. If it's not placed at the highest rate, then you just have to document why you might not have done that. And I'm sure there's certain situations where it might make sense why you wouldn't necessarily do that. But anyway, if you would do that, you just have to document why you didn't choose the highest rate. Another permissible investment is the money market mutual funds. You can only invest in those if they're AAA rated. The portfolio of that money market mutual fund is made up of U.S. Treasuries, agencies, instrumentalities, or GSEs, which are government-sponsored enterprises, or repurchase agreements with the collateral of those same eligible securities. They must be purchased through an approved depository, and they are always considered, or they should be considered, to have a final stated of 1 day. So basically, every day you're getting a new rate related to that investment. Other investments that are eligible, 5-13-9-2 talks about you can purchase securities, U.S. Treasuries, federal agencies, instrumentalities, and GSEs, and certain municipal securities. I believe that code site says that the municipality cannot have defaulted in the last 20 years. That's one of the requirements. But other than that, you can invest in the munis as well. Other eligible securities are securities that are issued by the IBRD, which is the International Bank of Redevelopment, or the African Development Bank. And when you purchase those type of securities, you would have to use a broker-dealer, and you should use a broker-dealer that is SEC licensed, and you can find that under that website, www.finra.org. To custodialize those securities you purchase, then you have to custodialize them in an approved depository or a financial institution that's not an approved depository but has a combined capital and surplus of at least $10 million. That really catches. There's a lot of the real big banks, custodial banks. A lot of the smaller banks don't necessarily custodialize securities like this. So, but like U.S. Bank, BNY Mellon, JP Morgan Chase, State Street, those are big banks that can also custodialize your securities. Those type of securities are supposed to be inside of 2 years final state of maturity, unless you adopt an investment policy that then allows you to go up to 5 years, from 2 years out to 5 years. I believe I have a later slide here that talks about that criteria. Another eligible investments, the repurchase agreements. Those are essentially, if you have cash, you're lending that cash out on an overnight basis, essentially kind of purchasing a security that they're buying back the next day. So it's a repurchase agreement. They're borrowing your money, collateralizing with the security. Next day, they're giving you your money back plus interest. Those should be collateralized. We typically require 102% collateralization on our repurchase agreement. And that's, again, as mentioned at the very start, these sometimes all these different investments can have different yields. And this is really still an overnight investment. It's not much different than money market mutual funds, if at all, at least not in this current market. But it is an option that you could always look at. And again, purchase that through an approved depository. Another a liquid investment, and is the local government investment pool, which our own Trust Indiana pool that's administered and run here in the Treasurer's office. Again, this is very easy to use, and I'm sure Cindy has coached in her presentation will go over all this a lot. I've got, just real briefly, I have about 7 or 8 different sub accounts now with them, maybe even more. But so I have different accounts. I have some general fund money in Trust Indiana. I may have 7 or 8 other sub accounts or other dedicated accounts or whatever that I want to keep liquid, and it's a good way, a great rate right now. So from that standpoint, I'm staying liquid. I can get that money really the next day if I needed it. And this day, if you do a wire or you do an ACH. But anyway, that's an option that works great. We are very pleased with that product that we use, that I use a lot. That's one of my investment options. Here again, this is which I mentioned from the beginning, the local board of finance. These statutory sites here describes the local board of finance members, whether they're county, a city, and or other fiscal body, and what makes up that local board of finance. Each local board of finance shall meet annually after the first Monday on or last day of January to complete the following. And that's where you elect your president, secretary. You review and see the report required by C5-13-7-7, and you review the overall investment policy. This report must also contain a summary of all investments made during the previous calendar year. And as I referenced in one of the previous slides, the political subdivision investment policy. Now, again, without this, you are all able to buy final state maturities out to 2 years. If you adopt an investment policy statement, you can extend your final state maturity out to 5 years. And again, this investment policy statement has to be in writing. It has to be adopted at a public meeting. Provides the investment of public funds with the approval of the investment officer. And there is a limitation. No more than 25% of your portfolio can be in that 2 to 5 year sector. So you got to keep that in mind. This particular policy cannot exceed 4 years. And you, as an investing officer, you can also contract with an investment advisor or other institutional money manager to make investments under this section. And then one final option, public officers, the investment officers, you can also have a contract for investment cash management system, and that has to be with an approved depository. And they can do your investing for you. All the investments have to fall within the same statutory guidelines of permissible investments. I believe that is it. Like I said, I wish we were all together in person. I'd love to have the questions right now, and I'm sure I'll have that opportunity. But thank you very much, and everybody stay well.